Okay, I believe we are live. This is the CCM Chit Chat Money Investing Power Hour number 55. My name is Brett Schafer, and I'm joined, as always, by my co-host Ryan Henderson on these episodes, which we do live on YouTube every Thursday, and then get the replays uploaded on your podcast feeds on Sunday mornings. We talk about whatever is happening in the financial markets. It could be specific stocks, earnings season, philosophy, some research paper we found, or maybe some more comical stuff that we found as the financial markets do get absurd from time to time. And this week we got a mix of both. We got earnings. Earnings are in full swing. Ryan has some notes here on Netflix earnings. I also have some Tesla earnings. American Express, and then a few funny things and maybe some more long-term investment management stuff. But don't need to spoil everything. Ryan, how are you doing today? What are you excited to talk about this week? What's on your mind?
Yeah, there's a lot. I mean, start of earnings season is always fun. Netflix always gets a lot of eyeballs. I don't know if there's anything in particular. There was some interesting stuff with Apple, which always seems to get overblown, but they might apparently just cause a full blown financial
I'm already
crisis.
I'm already gonna fade this, but I won't spoil your topic.
Yeah, there's rumors that they're starting savings accounts. Actually, they are starting savings accounts. So we'll see. I'll talk about that in a second. But you want to talk about our sponsor first?
Yes, today's episode is presented by Stratosphere.io, our investing home screen for fundamental research. I already have some charts loaded up for Tesla when I talk about their earnings report. Ryan is going to load up a chart right here that has, and I'm looking at it, a Pepsi chart. And when you look at some of these larger companies, I think every company in the S&P 500, every company within the Toronto, I don't know what the exact name is, 50, they'll have specific KPIs over at Stratosphere. And we talk about the specific KPIs that you can't get anywhere else, but they have much more. As you can see, anyone watching, they have analyst coverage, they have different modeling, they have what I like is a screener that they're improving day by day. And I just saw they released a chat GTP integration, that looks quite exciting. And they've
You
just
said
launched version one.
GTP. It's GPT.
GPT, thank you. I think everyone understands that, but sorry about that. Misspeaking there. And you can try that out. It's really, really helpful. They keep adding stuff to it. And the key to Stratosphere is that it saves us both time and frustration when researching companies. You can go check them out, stratosphere.io, or use code CCM to get 15% off one of their paid plans with lots of cool features that we know and love. We're going to be utilizing Stratosphere again throughout the episode, so you get to check out the platform. Link is in the show notes. All right, Ryan, let's get to this week's episode. What do you want to talk about first? You have the Apple savings. I guess maybe let's talk about that. Maybe that can be a fun discussion, although, fair warning, neither of us are banking experts, which you are probably going to disclose already.
Yeah, not banking experts, but some interesting news. So Apple launched a savings account for Apple Card users. I don't know how many Apple Card users there are out there, but they, I think it's basically just right within your Apple Wallet, I'm assuming. And apparently, I don't know if this was just like a screenshot someone took, but it's going to have like a 4% annual percentage yield is what I saw from someone's screenshot, but it seems kind of insanely high. Here's what the press release said. Apple today announced a new savings account for Apple Card that will allow users to save their daily cash and grow their rewards in a high yield savings account from Goldman Sachs. I don't know specifically what high yield will mean, as all these savings accounts do, but I guess the question here is, do they steal wallet share from other banks?
Potentially. Maybe. Actually, probably not. Probably not. I'm going to say no.
You're going to fade this. What
Yeah.
makes you think this won't work?
Well, I think it'll work, but I don't think it's going to have meaningful a meaningful change. There's net interest margin, not net interest margin, excuse me, whatever the interest rate that a bank has to offer is already seeing major pressure. I don't know whether this is going to be a major change to that. And is this going to make it so Bank of America, Chase, Citi, all those companies, is it going to force them to dramatically raise their interest rates? I don't see that happening. Why would you, if you haven't moved out of your the money that you have within your bank account at, say, Bank of America yet, why are you going to do so? Because Apple is offering this. It seems great for the stuff that's sitting on your Apple wallet, right? For the money sitting on your Apple wallet, that's great. But I don't see that money was already not in your Bank of America account in the first place. Are you going to move, Ryan, thousands of dollars to your Apple wallet? I guess you use a local bank, but if you were in
I
Bank
don't
of
have an
America,
Apple
would you
card.
Oh, so yeah, okay, but say you did because you're an Apple user. I'm not, loser apparently. The you have say you use Bank of America and you're an Apple user and you have the ability to use it. Would you be how incentivized are you to move a meaningful amount of money to earn 4% on something that was in your checking account, say $5,000, something like that?
If I was a big Apple Card user, I mean, maybe there'd be some incentive. I mean, you're getting 4% versus what? 0? What do you get at the big banks today? Like,
Yeah, say it doesn't really matter, much lower, right? There's a big
yeah.
spread on the interest rate you could earn.
The problem is, okay, the only thing that makes me think they might have some success is the success of Apple Pay. But it's important to distinguish Apple Pay is not Apple Card. Most people just pay, they just plug in their digital credit or debit card from their bank into their Apple wallet and just pay using that. Apple Card is just completely independent. And even though Apple Pay has grown really, really quickly, I haven't seen any numbers on Apple Card. So I'd be surprised if that's taken or had as much success as Apple Pay, unless I would really have no eagerness, I think, to sign up for Apple Card and use this because there's always some threat to banking. Like, okay, look at it. I mean, there's so many bank accounts out there now, high yield savings or a high yield, an interest rate higher than what you get at Bank of America or Chase. But those banks continue to grow deposits. Maybe not this quarter, but they continue to deposits, which I just don't think that's ever going to change. There's so much friction involved in switching bank accounts. It just is never really going to happen. I've been talking about how great it is that Ally gives these like insane rates, and yet I'm still at this regional bank that provides me nothing on my savings basically. So why? Just because there's so much friction, and it's one of those things where you're just like, yeah, I should switch someday, but you never do.
Yeah, if anything, whenever I have XX savings, I put it into my investment account. So I think maybe we're not because not everyone does that. So maybe we're thinking we have a little bit less incentive. I think, it's a good product. Apple seems to have these financial services things that they can add on and retain their power users. But these sort of stories get so much airtime within the news on Twitter or within wherever. And it's going to be meaningless to Apple's business. And it's going to be meaningless to the bank. So I don't really understand why these become news stories so much. I think, I don't want to say necessarily it's going to fail, but it's a pretty irrelevant product from an investment perspective, looking at Apple itself or any of its companies that it's trying to steal deposits from. And plus it's partnering with Goldman Sachs. So they if anything, Goldman Sachs will benefit, but we've seen Goldman Sachs, at least generally, kind of stumble with their trying to enter the retail depositor space, and they're not profitable at all there. So if anything, this Apple Goldman Sachs partnership has not shown to be super fruitful in the past. I don't know why this is going to change it. And if anything, what's the big deal if banks see deposit outflows? They start increasing they have a ton of wiggle room to increase their interest rates, right? It's not like, yeah, their business might suffer a little bit or their margins might suffer, but they can, if they start losing deposits, they have plenty of room to increase those interest rates.
Yeah, absolutely. I mean, I looked at Bank of America's earnings this year or this quarter, and the net interest. I mean, the people that bank with them,
What's their NIM? What's their net interest margin?
it's wider than it was last year. I'm
Yeah.
not sure what it was, but the thing about people that bank with those big banks is they aren't putting the money there because of some interest rate or some tiny, like, 1% difference. Chances are,
Especially a checking account.
yeah, chances are they're doing it because they like the service. The parents did it before them. Their parents did it before them. And so they kind of were just like raised into that bank. And then you probably are just so used to using it that you don't really care. And if you want to earn high yield, you'll probably go move it somewhere else anyways.
Yeah. It's interesting that there was this thesis that when interest rates rise again, that the banks were all going to benefit, but it seems like some of the banks benefited greatly. The ones that didn't get pressure on the lending side, or excuse me, the depositor side paying out the interest rates, which would be the big banks mainly. And then there was a ton of pressure for when they rose too quickly. And then they got some of the other banks, as we saw, ever so, whatever. The huge news story when SVB and Signature Bank failed, they had terrible net interest margin compression, whatever the asset liability mismatch. We don't need to relitigate all that, but they definitely had a huge headwind when interest rates rose. But it's interesting how not all banks are the same. Not all, when someone usually, I think not the key, but maybe a big takeaway is when someone says, or there's a narrative out there that says, when interest rates rise, banks are going to do well. It's usually more complicated than that, and it's never just all these companies are going to do well because some macroeconomic change.
Yeah, I think you're right. And the other thing that I think is worth revisiting is we can totally laugh at all the VCs now that called this a giant banking crisis. The earnings are out. This was not a banking crisis. It was basically no. There was such negligible money that came out of the regional banks and went into the big banks. Like it was maybe like a 1-day change. If I'm like, I don't know, I bank with a regional bank. I read the stories and I'm privy to a lot of the, financial information that's out there. And I care a lot about this stuff, probably more so than the typical banking customer. And there was never a point where I'm like, well, yeah, I'm gonna switch. It was just unrealistic. And I think the VCs that were saying that we caused this panic to save the common man.
They're the worst.
It's just, yeah, they are the worst. And if you solidified my belief that they're the worst.
Now, looking at the podcast chart rankings, there's definitely some overlap to that one show that has 4 people on that maybe have a poker analogy. I can't take that. Please, if you're listening to that show, I just gotta say they are all four of them are charlatans, and they've been known to be I just don't. It just really makes
we don't
me
put down other shows. We don't put down other shows. But what I will say is they look out for their best interest.
Yeah, well,
above all else,
they're
more so than most people. And it's a shame because there are a lot of VCs out there that I really I respect. Honam, he shares frequently on Twitter, and he was one of the first people that was like, someone said, like, why don't any of these VCs come out and say, wow, you know what? Yeah, we took too much risk having all our businesses put all their cash deposits in one place. And he was a big investor in Roblox who had a lot of money with Silicon Valley Bank. And he literally just said exactly that. He said, I think you're 100% right. We didn't see this risk.
It's just the inability to, and like, look, everyone has this instinct to not want to admit that you're wrong about stuff, but usually you do that when you're like 18. And I would think that when someone's like 40 years old, they'd be able to admit more when they're wrong. But the inability for a lot of these people to not admit when they're wrong, I think should be telling, and is a big example for anyone to learn in the investing universe. And it was not really a lesson for me, but another reiteration that it's much better over the long term to admit that you're going to be wrong, because it's kind of like, the baseball analogies fit. You're not going to bat 1,000 when making investment or financial decisions.
It is weird. And maybe those people that we not so subtly referenced are maybe just the loudest.
If you listen to that, you know what I'm talking about. But I think people are confused if you don't know what that show is, because I missed it.
Yeah, maybe they're just the loudest, but it seems like there's a lack of humility that was rampant, and probably a byproduct of all the money that flew into Silicon Valley over the last decade.
Yeah, and
I wonder and I would hope that some of this bear market would have an impact and kind of change their mindset, maybe, because their valuations don't continue to just go up and to the right.
Yeah. Yeah. I think it's fine if they don't. Like, they can act like a-holes. Try not to swear, but right? Like, it doesn't actually matter, I guess, unless they yell fire in a crowded theater with the bank run thing that they seem to cause with Silicon Valley Bank. And then I guess Signature was different because they're potentially, I guess we should say, potentially doing some crypto fraud. But
there was one headline that came out of this bank earnings season that would probably scare people, which was Charles Schwab bank deposits declined by 30% year over year. And so if you just looked at the headline, you'd say like, oh my God, that's,
but
there was a real panic. But it's also worth noting that interest rates are significantly higher. So there's less traction to just holding it in cash at banks.
So they're staying at Schwab, but they're in a different.
Yeah, they probably have it in some bond or some yielding security, where it's a safe yielding security. They even said like very few of the withdrawals were because of the panic. It was primarily because there's better alternatives to cash now. And then on top of it, more people are probably using their cash. So
yeah,
it's kind of unfortunate that they had that headline this quarter.
All right, make a prediction though as we move. I want to talk because we had other topics that I think will be more exciting. As much as I want to talk about banks for 20 minutes, is the banking crisis? Was it a fake phantom banking crisis, or is it just going to a slow moving train wreck where we could see some more pain over the next few quarters? What side? And obviously, don't make any investment decisions based on these. This is just for fun. What side of that the room do you land on? No banking crisis or start of the banking crisis, and it's just the calm before the storm?
No, I'd say it's over. And I'm sure maybe there were people that said that in 08 or whatever, but
yeah, there definitely were, but that doesn't mean that this time it's not. You know what I mean?
It's very
people
different.
Always take that. Of course, people in 07 were saying that things were fine. If they weren't, then the stock market would have already crashed. But whatever.
And if you look at the banks that did collapse, and maybe there were some smaller ones I didn't look into as much, but like Silicon Valley Bank was a very unique situation. Like most banks do not have
unique. You mean stupid?
Yeah, there was the interest rate risk was. I mean, there was a lot of greed, I think, in going for longer dating assets. But it's also probably a part of just being in that VC culture, being in the Silicon Valley mindset. And there's so much money flowing around and sloshing around. And you probably start to believe that this isn't going to change significantly because some guy in Washington, Jay Powell, decides to take the rate up. Like, it's not going to change my whole life, and all of my customers aren't going to lose all their money, that kind of thing. I'm sure you get in that mindset that not all your deposits are at risk, but I mean, like, what other banks have probably 50% plus of your assets or 50% plus of your deposits controlled really by like 2 or 3 people, like, because they're the prominent VCs that can basically dictate what their companies they've invested in do. So
Yeah, yeah, that's
customer
definitely,
concentration risk.
yeah, for sure. And I'm gonna lean on the side of it was a phantom banking crisis, and that's what I think we can call it if we are correct here. However, I am open to the idea of the people talking about the commercial real estate risks and stuff like that. I could see that. There's a lot of thoughts around that on headlines and stuff like, but we'll see. We'll see. I think I lean on the side that it was so overblown because remember, it took over. Everyone was talking about it for about a week, right? I guess I'm out of the country, so I don't really know. But you were correct, right? I'm correct on that. Everyone was talking about it for a couple days there.
Yeah, I heard like maybe some casual references to it for people that weren't in like the finance community. They were like, "Yeah, I heard some bank in San Francisco collapsed."
Yeah.
The anyway,
All right. Next
wait, I do
topic.
have one
Oh,
thing
okay.
that's
One more thing.
maybe not that interesting. Maybe it
Oh boy.
is. Depends on if you're into the financials, but this figure might shock you. Blackstone's AUM in in spite of all the news that went on with them, like withholding withdrawals or whatever, increased 8% year over year, almost to $1 trillion in AUM.
Yeah. I don't like that stuff. I know there's so many smart people that put good pictures on them and KKR and stuff. I just don't like the private equity. It seems like it's a whole nother topic, but I just don't like how with interest rates rising, um, their funding costs increase, right? Unless they're getting outside capital. But I guess for leveraged buyouts, right, their funding costs increase. I also don't like how they treated their customers with BREIT. And I also don't like how there's better lower risk alternatives for say a 4 to 5% return in treasuries right now. And I just think the differential of capital allocation over the next few years, if interest rates stay higher, it just concerns me about what their performance is going to be and whether their volatility laundering, as some of the prominent analysts have to say. However, private equity, factor-based investing, all that any quant stuff, any big sort of macro investing categories where people talk about private, you know what I mean, where it's not like individual companies. It is a bit over my head, so I get confused of it. But it is impressive though that they keep them growing. Like they go in spite of everyone hating them in the investment community, they keep growing. What would you say? Not deposits.
AUM.
AUM. Canon. Yeah.
Well, I guess if you withhold people,
if
you stop people from withdrawing, yeah. AUM is going to go
and you
up.
Keep, and you keep your AU, and you write and you mark your AUM yourself sometimes. So
the other, yeah, and that's the other interesting part is, and maybe there isn't any incentive to do this. I don't know, but their distributable earnings was like $1.2 billion for the quarter. Those were down, I want to say 35% versus last year because they earn a lot of performance fees on liquidity events. So when they sell the asset, and so they said, right, we weren't able to sell as many of our assets, so we earned less money, but they're not marking down a lot of their assets that they own. So if way less people are buying them, isn't that a sign that they're probably not worth as much as you're quoting them at?
Yeah. And that's the biggest, really the key problem I have is just earning the fees on that while marking something up higher and earning either a management fee or a performance fee on that. I mean, VCs do it too. It's not just Blackstone. It's a whole thing in that industry, but I think that's a topic for another day. I want to hit the other topics we have. You have Netflix earnings. Let's do that. Seems like a fun one. I feel like the bear cases are officially, it's done. It's yeah, I think it's over.
Maybe there's a lot of ways to look at it.
Well, I'm talking about the bear cases that they were going to go bankrupt.
Oh, Netflix? Yeah, no, I think that's in the past. But so I read the quarterly results. Did you take a look at them?
Yeah, I usually give them a glance, but typically you have a chart here from the Science of Hitting Research Service, which we subscribe to. I usually go for Alex over there, covers about 12 to 15 companies on a regular basis, Netflix being one of them. And I usually kind of outsource it to him because he does
such a good job. Yeah.
He knows that company extremely well. So if you like Netflix, he gives the best overview, I think, each quarter.
Yeah. I guess there's a lot of ways to look at it. So the total subscriber growth was lighter than people were expecting or the street was expecting or whatever. I mean, it's still growing, but it's kind of slight. And it's not, the membership growth is actually declining. I think it declined year over year in the US, or what do they call it? UCAN. But Alex kind of puts an interesting spin on it. He said in his coverage, he said at the end of the first quarter, so this most recent report, Netflix had roughly 233 million global paid subscribers. As you can see in the chart below, this total is 40% larger than it was Q4 2019, so pre-pandemic. Given the competitive dynamics at play during the intervening years, which included aggressive pricing by legacy media companies looking to establish a DTC subscriber base, the precursor to building a DTC business, which is direct to consumer, I think double-digit annualized subscriber growth for the incumbent after 10 plus years in the business is an impressive outcome. I think that is because so many people looked at it and said, wow, this business is maturing. Global streaming subscribers are flatlining. This is not the subscribers. This is the content spend that Brett's showing right now, if you're looking at it. But Alex does kind of he puts a different spin on it, which if you zoom out, I think he's right that there has been, it's been like the ultimate competitive environment. HBO, Disney, all the Disney subsidiaries, ESPN, Hulu, stuff like that. I'm probably missing some. Paramount. They've been
Paramount
aggressively
Plus. There we go.
discounting.
Paramount Plus has actually done well. I said that jokingly, but yeah. Continue.
Aggressively discounting, and in spite of that, Netflix's subscriber base is 14% higher, 40% higher than it was pre-pandemic, in a period when they, as far as I know, they have not been discounting. So maybe in some of their more developing markets. So I think that really is a testament to them as kind of the premier player.
I want to get to the discounting and the developing markets because they have been, but that's another topic. You have the chart here on the content spend. Curious what your thoughts on that were. Why'd you want to share that this week?
Well, I find this interesting because the revenue has continued to grow, but if you look at 2021 spending on content, cash content spend versus what they're expecting for 2024, it's actually down in 2024 relative to 2021. So they are spending less. And then now this hasn't happened, but their estimate for what they're going to spend 2 years out is less than it was in 2021. That's basically accrued to cash flow. So they're expecting $3.5 billion in cash flow this year, and it's more than they were guiding for initially. Does it concern you that content spend isn't growing? Because my thought would be, if there's so much demand for engagement, wouldn't you be and Reed Hastings has said that he wants to increase content spend over time because that means the business is doing well. But the fact that they're guiding for flat content spend, I don't know if that's, wow, look at management, like that's a really good job controlling your costs, or that maybe they're being cautious because they don't think they'll grow subscribers by that much.
Yeah, that's an interesting point because and this is reminding me, we just did an interview with Leandro from Best Anchor Stocks on Copart. And one of the key reasons people like that stock, why he likes that stock, is that because they can invest a lot and then get and incrementally invest a lot each year and then get a bigger return on that investment through classic growing your business with a strong return on invested capital. And Netflix, I think, you'd want the content spend to grow over time because that's basically their capital investment. And if that's increasing and they're able to grow the business, then the business will be bigger and the stock will do well. However, what I think is interesting is if maybe they overspent or grew too quickly, kind of heading up into that the pandemic kind of skews it a little bit into that 2021 period. And now they're normalizing a bit, and then they'll incrementally grow over time, because I think there's a few different ways they're going about it that can increase their revenue in a way that's not going to kill their customer base, while also it's in a way that's not going to, they don't need to increase their content spend to do it. It's just optimizing their current business. Because if you think about it, they have the global subscriber base and they have the content spend. If they had one subscriber, that's obviously very, very high incremental margins there. So first thing they're doing is they changed the pricing to be more cost available, I guess, for most consumers in, I think, like 150 countries. So say a lot of the countries that where the GDP per capita is quite low. The biggest example they gave was India, where they cut prices by, I think, over 50%, if not more, where I think that's smart because if their content spending is flat, then even if they're adding, say, 10 million very, very low price subscribers in India, that will be margin accretive. Second, the advertising tier, which seems to be small but successful, where the ARPUs are very strong. That can help as well. And then the password sharing, I think that's probably the hottest topic that might be the most controversial of when they implement it. But they said that in their 4 test markets, it was subscriber and whatever revenue accretive. I think they either said revenue or subscriber accretive. I'm just going to go with revenue. They said it was good for their business financially in their test markets, and now TBD whether it hurts their customer base over the long term. But I think doing those 3 things will help them grow the revenue, even if content spend trails that, which I think is great for cash flow.
Yeah, the other thing is they said that their ad-supported plan now monetizes better than their standard plan in the US, which I think a lot of people were skeptical about that. But
should they
if
lower
that's the case,
yeah, do you think should they lower the price on the ad plan? It feels
if
like
they're
it's
getting
not
that good of an ad load, I would say yeah. Or you could
to make it
potentially
a big enough difference, you know what I mean?
they're
Of
already raising prices on the standard plan. I think revenue was up 9% in UCAN. Maybe it was 8%, and memberships was down 1%. So I mean, it must be pricing is the difference.
yeah.
But do you think it'd be better for them to lower the cost of their ad supported or raise the price of their standard plan? Because I guess they can, because their ad supported monetizes better.
Yeah, my gut would say keep a good separation between the ad supported plan pricing and the non-ad supported plan prices. However, I think this is one where you defer to the company where they have the analytics to know what works the best. So they're going to have the data. It's just going to be a data driven decision there.
There's also there's a couple of other things they can do, and so there's this Twitter account called Title Cap that did something kind of interesting, which basically laid out there's a couple of ways to make this potentially even better, I guess, for Netflix. So they can potentially do like tweaks to the service. Like maybe they could downgrade what you get with basic with ads or ad supported. Kind of like I know YouTube Premium doesn't really do this, but if more people sign up for YouTube Premium, there's more ad load for the people that are still on ad supported. So you could just kind of bog down the ad supported service until people switch. The only thing that's interesting is if ad supported monetizes better, maybe you want people to downgrade.
Yeah. I don't know.
It's less predictable
TBD. TBD. Yeah. I think we'll see. We'll see. I don't have any big takes on there.
Do you think you'd ever be an investor in Netflix?
Yes. Now, yeah. Unfortunately, the price was better this summer. Where looking back, like if I had the conviction this summer that they were going to get through that period, which is why that opportunity is there, because there was a lot of people like us that were doubting whether they were going to stay as relevant as they were. I think, yeah, they're making a lot of right moves. I don't know what they're going to do with sports. And obviously that live thing, whatever, they had a bug recently, happens to every company. Yeah, they're doing great things with the sports documentaries. That seems smart. The reality TV stuff is pretty damn smart to embrace that, kind of kill all the old cable channels that had that, you know, the ones that young people all used to watch, like whatever music-based ones, love-based ones. Everyone knows Love is Blind and forget all the other ones, but they have a lot. I think, yeah, very, very smart. And let me look at the stock price.
Here, there's an interesting quote too that I saw this week, and this was from an interview like 5 or 6 months ago, but Reed Hastings was interviewed and he said, I have two religions, customer satisfaction and operating income.
Yeah, he's good at propaganda. They're the best at corporate propaganda. Just don't, you
Not even
can't.
propaganda though, but they
That's
like,
propaganda. Yeah, it is.
it's propaganda,
It's
but they
investor
back it up.
propaganda.
But they back
Yeah,
it up.
true. Yeah. It's not fake. Yeah.
And they also have one of the most, I think, kind of lean cultures or cutthroat cultures, but all the employees at Netflix seem to like it,
Yeah.
which, and because it's literally in their stated plans. They want to hire well, like teach employees well, and fire well, which is kind of like most companies don't come out right and say it. So maybe it's a
Yeah. Okay.
interesting tactic.
Yeah. The last thing on Netflix here. So stock price is about 326 today. Market cap say 145, but in the summer it got down to about, let's just call it 200 because you can't perfectly time the bottom. 200 would have been something like a market cap of what? I'm trying to do some math here. Let's say roughly like 90 billion. I'm trying to do that math in my head. Let's just say conservative 90 billion. I mean, there's a clear path to them going to 10 billion in cash flow a year here if you think they're right, where they can leverage this content spend like they are now trying to do. Yeah, I mean that the stock would easily be cheap there. I think. Yeah, I mean, I would have bought it. I would buy it now at 200, 250, but I don't know if it's ever going to get back there. I do like the business now. However, I like gaming businesses like I like EA and Take-Two Interactive a bit better. However, Netflix has much more recurring revenue. They are a bit lumpier, and that's I think why they get a discount. But I do like them a little bit better. I think the growth prospects over the long term are similar, but Netflix is a bit within their core industry.
I might give Netflix the nod.
Yeah, they have a better competitive advantage within their industry, but I just worry a bit about trends in general, and this is why Netflix is investing in gaming, about general usage or entertainment usage around the world going to gaming instead of TV and movies. So that's why I like the gaming market a little bit better. And that's the big, I think, concern with me with Netflix, but their actual competitive advantages versus industry participants, I think, yeah, it's widened over the last 2 years. And I like it a lot.
Yeah. And for context, they're expecting $3.5 billion in free cash flow. So price to free cash flow is like price to expected full year free cash flow is like 40 times, a little higher. Still a premium, obviously, but every time I read their like letter or their quarterly earnings, I think like, I don't know how I feel about this. And then I read Alex's write up and I'm like, yeah, I can invest in Netflix.
Yeah, I mean, I do think the password sharing is going to be good. People are going to hate it, but they're going to like tough love. It's a little tough love.
The funny thing is,
for their customer base,
Netflix in general is kind of, and maybe this is just like my cohort of friends, but everyone I know, like, who has a Netflix subscription, they're like, yeah, I don't. They say they prefer HBO. They're like, I don't even like the Netflix shows. They're terrible. But
yeah, but data, I think data
it
doesn't back
works.
that up. Yeah,
I know.
I think the data doesn't back that up on usage. Although I don't know if you like, if you're watching 10 hours of like background stuff on Netflix, I don't think that is apples to apples to a 1 hour show on HBO that you really, really love. But again,
It also has such a better user experience. Like,
yeah,
it's a way better app.
Speaking of
than
Succession,
HBO's.
yeah, that's like they all go, yeah, it's like Star Go. Remember that one, The Circle? Yeah, that's a little bit too on the nose that HBO Max produces that show. Okay, next topic because we don't run it. Yeah, well, we got 20 minutes. We got plenty of time. Tesla earnings. We always got to do this for engagement bait. What'd you think?
Well, I think the financial results look a lot like what you would expect if you saw the events that led up to it.
The price
So,
declines. Yeah.
if a company drops prices that quarter, you should expect margins to probably come down. If a car company drops prices, you should probably expect margins to come down, which is exactly what happened. I hope nobody was shocked by that. The funny thing is, like, it used to be, and now the thesis always changes. but the thesis is that they're doing this on purpose. They're dropping prices on purpose so they can just skyrocket volume so that there's tons of cars on the road so that when they finally unlock full self-driving, it'll be that much more valuable to shareholders, that much larger of a value unlock. The thing is, if you're doing that at the expense of profits right now, it's no longer a cherry on top of the thesis. It is the thesis. Like they don't, it's not nice to have that additional unlock of software revenue. They have to have it in order for this to make sense. So I don't know. That would be, I'm skeptical of their autonomous capabilities to begin with, but there are a lot of people that believe in it. And I would say that kind of, for me, the thesis is obviously changing.
Yeah. And I think here, I have a chart here loaded up for the audio listeners. I will explain it. It's from Stratosphere. And what's great about them, they already updated the KPIs pretty quick, which good to see that. Their revenue was up, I believe. I think it was, yeah. And their unit volumes were up. And I think when people look at that, you have to really look at the underlying profitability, because their automotive gross profit in Q1 of 2022, when their operating margins and their gross margins peaked, at least maybe they could go higher over the long term, who knows? But their operating margin in that, gross profit generation in that quarter last year was 5.5 billion. This quarter, the one they just reported, even though revenue and unit volumes were up 4.2 billion, and we're seeing operating margin go in the exact wrong direction. So I think the key concern for me is that the stock is valued at a company that is going to grow, say, 2 to 4 times the revenue, which is maybe doable, but have 15% to 20% operating margins. Now, if the company at a $500 billion market cap has 5% operating margins, you need Walmart level revenue generation, which means they need to somewhere in the neighborhood of 6 to 7 times their revenue base. And can they do that? Can Tesla do that? I just don't think so. That's the big concern here. So I think the margin deterioration really, really would concern me. That right? I think the thesis was that margin expansion was permanent, and I guess we're seeing that it was a little bit of a COVID supply chain, supply restriction benefit.
Yeah, I mean, I don't understand why people are like debating it.
They wouldn't
they decrease prices. They decrease prices because they had to. It's like it's that simple. And I'm not sure. I know people want Tesla's kind of become religion for a lot of shareholders, or it's kind of become a cult. And I get that. People love the company, but if you decrease prices, it's indicative that people aren't buying your cars at the old price. So there was a lack of demand.
Yeah. And what's interesting is so far, and I think the account that Jim Chanos runs, and if you use Twitter, the account is called, what's it called? Well, I'm forgetting it. Wall Street Cynic. He had a good interesting point, because the narrative has been out there, I guess the bold narrative, which, it could make sense if it was showing up in the data, that they're trying to take advantage of that they're the biggest player, at least outside of China, with their already ramped up manufacturing, and kind of play a little price war and try to hurt the EV margins of some of their competitors. However, so far, and I guess we'll see over the next few quarters, it hasn't shown up in a lot of their competitors yet. I think he showed that Mercedes was doing just fine, which I think makes sense, because Mercedes has the ability, and I guess they're not going to be a mass market brand. They have the ability to sell a car for $100,000 to a lot of these rich customers, compared to Tesla, which is trying to compete for someone paying 40 to 50,000, at least on the base end.
Yeah, the other thing I think about a lot with Tesla is, do you really believe that most cars on the road are going to be a Tesla if they flood the market with volume or with extra cars? I feel like it becomes less attractive to have a Tesla.
Yeah,
Because it's kind of cool because it's different right now, and it's maybe less so different than it was 2 years ago, obviously, but
I'd say
it's unique.
specifically
And
on the West Coast, it's very mainstream now.
yes, I think they're going to have a harder time hitting their 50% compounded annual unit growth over the next decade than they expect.
Yeah, and to
Maybe
close things
shareholders
out,
expect.
because I want to do another topic here because I know we could talk about this all day. What was I going to say? So, what do you see? Maybe this was a pandemic stimmy thing that happened when you see what do I want to call it? Your neighbor that you think you're wealthier than driving a Tesla, and you're also driving a Tesla. When you think because I know people have these in their head, they want to be superior to everyone else, right? When you see the person you want to be superior to also driving a Tesla, it makes the differentiation less. And that's why historically, I think it's the key reason why the car market has been so fragmented, because people tie a little bit of their identity to what they're driving. Why do you think Subarus dominate in the Pacific Northwest where we live? I mean, I think that's the key there, where there's never going to be a mass market vehicle like an iPhone. Anything else before we go to another topic?
No.
Okay.
It's Groundhog Day sometimes with these earnings because it's like
it's the same. Yeah. Well, the first week is always Netflix and Tesla. So
the results were a little underwhelming, but then on the conference call, he says full self-driving is coming at the end of the year, which, for the record, he has said like 8 times
did he? Wait.
in the last 10 years. Yeah,
wait. He said it again. Oh boy. Oh wow. Well,
gotta have hope.
Okay.
Hope is an important part of the thesis.
Yeah. Don't base your investments off of watching Shawshank Redemption.
All right.
Here's the next
one
one.
To talk about
American Express, and then this will be a fun little macro one as well. Pulling up a chart right here. Oh no, please. Okay, yes, the share screen was going right over the chart at the beginning for me. Okay, here's a chart from there. I'll try to describe it as simple as possible. So in their earnings report, they just had a great one, is their historical volumes trend. And typically, and this is for American Express, and it's just network volume spend, and network volume spend equals revenue. And it also can be a big indication on the health of the consumer, especially the upper middle class to wealthy consumers in the United States, Japan, and Europe. So if we look at network volumes indexed to 2000, they have somewhat of a trend, like a linear trend growth that, yeah, it went like, I don't know. Everything seemed to be growing very, very linearly. And in the great financial crisis, they saw a little bit of a downturn compared to that trend. It was down 9% year over year. And then during the COVID pandemic, during 2020, obviously saw a downturn, especially within their travel and entertainment index. You know, people aren't spending money on planes. However, instead of just going back to trend, like coming out of the great financial crisis, in 2022, we're seeing a huge boost from the network volumes index to 2000. And there was a great tweet here from Wall Street Dropout, who said, is there a structural reason why American Express volumes don't revert back to trend? And just kind of some throwaway responses from people. Curious your thoughts here, because I think one, inflation might be helping them here. But two, I would be a little bit worried that we're in a time period where they're over earning a bit.
I think the wealth effect probably helped them in 2022.
Yeah.
Would you
and
agree?
they just said in Q1, you know what's crazy? I believe I don't have this in front of me, so I could be getting this wrong. Either in March or in Q1, they saw acceleration in spending. Acceleration. That's kind of crazy.
Yeah. I mean, the volume growth has been impressive, but I also think a lot of it might have to do with the fact that they are doing a really good job executing. Also, their fastest growing demographic is their youngest demographic. So those people are going to have more money to spend as the years come. So I mean, the trend's they're not going to grow as quickly as they did in 2022, but first quarter results looked pretty good for them, aside from the higher provisions for credit losses. So, I mean, I feel like it would usually revert back to trend. And if I were betting on American Express, I think that's probably the most likely scenario, or at least growth won't be what it did, what it was a year ago. Um, but I would expect them to continue growing. I would not expect this. I would not expect volumes to decline this year, given, first of all, their customer demographic, which is super affluent, high spending individuals. Um, but also, I don't know, like if you're paying $700 for a platinum card, don't you feel inclined to use it as much as you can?
Yeah. But remember that Dave Ramsey video from this week? That spooked me.
Yeah.
That'll spook you into becoming a permanent bear. Yeah, I think you might be right. They might just be a better managed business than before. They might have just, and yeah, inflation helped them a bit and stimulus helped them a bit, but they might just be better run. I don't
Yeah,
know.
I mean, there was more money probably to go around. I'm sure that helped the trend. But
Oh yeah.
like, if you look at the first quarter results, I don't see how you look at it and say network volumes will decline this year. It just seems very unlikely.
Wow, you better knock on some wood, Ryan, because you're
I'm
trying
talking
to
about,
you're trying to jinx them.
I mean, the growth rate might revert
Well, of
back,
course, of
but
course,
I'm
of
saying
course.
like, you think network volumes would decline?
No, I don't think so. But you are trying to jinx them.
I mean, they declined 9% in the great financial crisis. That's really, I mean, and it's a much better business in my opinion than it was then.
Yeah, again, you were trying to. I know. I agree with you, but you are trying your hardest to jinx them.
I read the earnings this morning. I actually thought I don't know. It's a business that I find really attractive, but
Oh
that
yeah,
is cause for concern that they had that massive acceleration.
yeah. It's almost like the business. If the business is too good, people get scared, which is weird.
Also, if volumes decline, they can still just raise card fees.
Yeah, yeah. All right, next topic. This is a fun one. This is a question for you? Is Taylor Swift a better investor than the majority of the venture capital firms out there?
I
Now,
saw this.
here's what Taylor Swift, and I think everyone in the financial world, if they weren't already in love with her, is now in love with her, because here's what there was a big, I think, whatever, there's a lot of stuff coming out from FTX from time to time. Here's a quote from some lawyer in the lawsuit. The one person I found that did due diligence was Taylor Swift. In our discovery, Taylor Swift actually asked them, quote, can you tell me that these are not unregistered securities? End quote. Wow. I mean, when is she raising outside capital? Because I gotta say, we get these things. There's like a Kardashian fund out there. Let's get the T Swift fund going, because she
Do you
avoids
think
this. I
that
mean,
was
all
her?
the other, that was her lawyer. Yeah, I mean, it's still, but it's smart to talk to your lawyer, right? Because
Yeah, she was
the
offered
other people
100
that,
million.
yeah, 100 million. The other people in this lawsuit, class action lawsuit against them, I mean, Shaquille O'Neal, Tom Brady, Larry David, clearly have multiple lawyers working for them, and they still did it. Yeah, I mean, isn't that crazy that all you had to do was say, hey, talk to my financial advisor, talk to my lawyer, and say, hey, is this like, what do you think about this? And basically every single one of them say, yeah, that's probably a bit sketchy. And then you just ask them, hey, am I hawking securities here?
I
And
think, and I think it was Elon that initially tweeted this actually, but apparently Taylor Swift's dad was like a prominent investment banker. So
there we
maybe
go.
maybe there's some ties
You
there.
know,
Maybe he knew.
yeah. I found a book, speaking of TV actors, the actor that plays Elaine in Seinfeld, and also the V character, Julie Louis-Dreyfus, is the great granddaughter, maybe great granddaughter of one of the leading commodity trading companies, which is called Louis Dreyfus. So isn't that funny? I read that in a book, and it was like, the company was Louis Dreyfus, and I was like, that's the same as Elaine from Seinfeld. And I was like, I looked it up, and
Yeah,
it was right. I was like, yep, that's the same last name.
interesting.
All right, we
Yeah.
got 5 minutes left. Anything else you want to talk
Uh,
about?
I've been reading, what is it, The House of Morgan or whatever.
Oh, that's a big project. I stopped reading
Yeah.
that.
Yeah, no, I'm considering ceasing my research here, but I do find it, I don't know. it is kind of interesting how long they've been around for and how just like absolutely resilient they've been
Yeah,
throughout all the
great brand,
crises.
great brand, great brand. All right, well, let's just talk Succession for 3 minutes if you want. What'd you think last episode? Was it good?
Yeah, I thought it was pretty solid. Um, what's her name? The Weasel came back.
Oh, you're not a fan of Carrie? Oh no,
Not
Marsha.
not
Marsha.
Carrie, Marsha. I don't like Marsha.
Yeah, she is very mean and yeah, selfish. Yeah, she's extremely mean.
I
Yeah,
liked
it's not.
uh I liked Connor in this episode. I've always thought
Uh,
Connor was an underrated character.
yeah, he's got
Probably
his
one of my favorites.
yeah. Even though he's clearly pretty crazy, he's strangely got his head on straight in some aspects. Although he talks about the funny stuff about being the crazy libertarian political candidate. Yeah, I
He just
think we're
has
rooting
less to
on.
care about.
Yeah, yeah, exactly. I'm rooting for Carl. I think for
You like
sure.
you like
Oh
Carl,
yeah,
huh?
yeah. Carl's my guy, dude. They said he's basically John Malone.
Cable Cowboy.
Yeah, what that I mean, no one. I think no one except people that are investing people or fundamental research, whatever diehards, or even cable people were not like no one else laughed at that line. But when they said, I was laughing for a solid minute when they said what you did in the '90s in cable, extraordinary.
Yeah.
It was. I mean, that's such a good line. That just shows that they, unlike some other finance shows out there, this show actually talks to people that know what they're doing. You know what I mean? Because that's
Yeah.
something I would say. That's something people would say.
Yeah, they do
So
a good
funny.
job. Um, no, I thought this was a
Ooh,
good
we got a
episode.
we got a question. I think this will be a fun one. We did a show on Monster, which we did covering Monster Beverage. Check it out. What do you question from Kingsley? What do you guys think about Celsius? I think high risk, high reward. Yeah, high risk, high reward
Um,
potential.
we're going to be talking about Pepsi tomorrow, but it'll come out next Tuesday or this
Yeah,
Tuesday, I guess, if you're listening to this on Sunday. But um, they recently took a big stake in Celsius and basically took over the logistics and fulfillment for them. I think it's a good way to go. It's basically what Monster did with Coca-Cola,
could be very
um,
smart. Yeah,
2014.
it could be a 10 bagger from. I mean, it's high risk, high reward. It's an emerging brand. Emerging brands are high risk, high reward opportunities.
If Celsius gets, this is the part that frustrates me, is because we've done the CPG theme now for the month, and I keep thinking, if there's a business that's growing volumes, that has an addictive product, and has a large runway to
Yeah,
keep growing volumes, just buy it. But I'm seeing this with Celsius now because it fits the bill, frankly. And I'm like, I'm just not looking at it anymore. And I was thinking about it this week, like, God, it would have been so cool to invest in Monster and just hold for 20 years. I know it's obvious, but you would have outperformed, like, I don't know, almost all funds except Jim Simons.
oh, you definitely. I mean, still outperformed him. I think at least compounded. Because remember, those returns aren't compounded. That's why those returns look so good. Um,
Yeah. It just,
yeah. I mean, let's look at the Celsius returns.
I like Celsius. I like the product. The business is not without its problems. And if I'm not mistaken, there were some accounting issues
Yeah.
that they had. Maybe don't think as highly of the management team as I would have with Monsters.
Ooh,
Um,
Kingsley is saying that they are based out of Boca Raton. I did not know that. I gotta say, don't like that at all. Boca's fraud central, but not to say they're fraud. They're clearly selling real products. Stocks up.
well, they were, yeah, they
Guess
were,
what?
they're
Guess what the stock's up in the last 5 years? Give a gold guess.
12x.
Oh, wow, pretty close. 1,500%. So I
That's
think it
pretty
might it
impressive.
might be
It was a
expensive.
different business. I mean, it's very similar to Monster, honestly. It was a very different business. They came out with Celsius, completely transformed the brand or completely transformed the company. I think they have a new management team in place. Um, but I think it's intriguing. I actually like the Celsius product. I think they have kind of interesting counter positioning to Monster because they like
Yeah.
treat it as the more healthy, like
Yeah.
energy.
Even though it's not, but whatever.
Um, I like it, but it does trade it certainly trades at a premium.
Yeah, yeah. We got to wrap up the show, but yeah, it could be one where like you put on the watch list and they start performing, and maybe, you know, when we saw with Monster studying them, there was a period where they totally just rocketed higher, like up 1,000%, and then was flat for a while, had a little bit of a downturn, but the business was still chugging along, and that could be your buying opportunity. So who knows?
I think that Pepsi stake is, if you're a shareholder, I'd be very optimistic about that because that takes
100%.
away a lot of the big risk, which is in all in the logistics.
Yeah. All right. Well, that's going to do it for this episode. Remember to watch these live on Thursdays. Sometimes the time changes. It was 2 p.m. Eastern today, depending on our work schedule. Yeah. And you can get the replays on YouTube or in your podcast player of choice. We don't care. We just thank you for continuing listening. Remember, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. Remember, we are general partners at Arch Capital, and clients may hold securities discussed in this podcast. Thank you all for listening. Kingsley, thank you for that comment there. That was very fun. Anyone who wants to comment, come on here. We'll answer them. There aren't that many people. So thank you for those who do, though, and we'll see you next time.